Good evening. Today we're going to start with the explanation of the bonus question of the assignment. It is something that is going to reflect some changes that we're going to start to see in the course. First, a reflection. We have just crossed the equator of this course. I'm going to do the exactly, there you go. We just crossed the equator of this course. We have seen more than half the material, and now things will start to come together. And this bonus question is the first example of that. So to explain it, I'm going to have to go back to some things we already discussed in the past. So I'm going to bring up the assignment, and I have to share several documents at the same time. So I'm going to share my entire desktop so you can see all of that. This is the assignment that I gave you. The first part is easy. I want you to download the daily prices of those indices and play with them. That's easy to do. Then I want you to do the correlation matrix of the daily returns. Do not forget to do the daily returns. You have to do the correlations of the returns, not the prices. If you do the correlations of the prices and not the returns, you get a very high number. It has to be the returns. Okay, I'll remind you the returns was the value yesterday. Sorry, got it. Remind you the return is the value today minus the value yesterday divided by the value yesterday. These are the returns. This is the series of numbers that you have to use for the correlation calculations. If you do the correlations of the numbers, you get a very high number. Not right. So that's that, and you're going to get a matrix. The matrix is going to be something like that. You have ones in the diagonal because the correlations are always one in the diagonal. And then you get numbers here. You have three numbers to get. Three below the diagonal and three above the diagonal. So all of that will have to be, you'll have to understand. It's something that we discussed in a previous discussion here. When we were looking at correlation, it was done here. Okay, so you have to use that. And if you use this in Microsoft Excel, or something like that, it will all work. This numbers is what you're doing. Okay? And the correlations that you see here are between -1 and 1. So that part should be easy. You should have no difficulty with it. The part that requires a different type of organization of the data and a different calculation, it's not difficult, but it's the second one. The bonus question. So I want to explain to you what that is. You probably already know. I gave you this a week ago. Maybe most of you already know what that means, but I want to make sure that you understand, because some of the interesting analysis comes when you do these type of analysis. And for that, I want to remind you of something we already saw. It's here. Remember we saw that? What was this? This was the following. When you look at a point, a number, this number here, what is this number? This number is the mean of the time series 2 years before it. The time series is not here. Here is only the mean. So this number here corresponds to the sum of some values for 2 years. And it's an average. So all of this is divided by, if it's 2 years, that will be about 700 or so. Okay? That's what this number is. And then as you move that window one day forward, then that number changes. This is what's called a running mean in this case, and I'm asking you to do the running correlation. And that is something which is a bit more, it's the same idea, but it's a bit more involved when you do the calculations. Okay, so it's very, I don't know how good you are in Excel. I hope I suspect you're good. When you do this in Excel, it's actually very easy to do. Excel allows you to do this. To do running windows is very easy in Excel. Okay, you have a long, if you have any difficulty with how to do Excel, I'm happy to spend some minutes and I can show you how to do it. Okay, but I suspect you already know. So what I wanted to make, the remark I wanted to make is, this is how you do the second part of the assignment, the bonus question. It's going to be a chart through time of the 2-year rolling window. So you're going to pick a window of 2 years. If you do this in Excel, typically these are going to, the 2 years, you typically have the time series expressed as a column. Okay, you typically, I'm going to share my, I'm going to stop the share and I'll explain how you do this algorithmically. This is something which I want to make sure that you'll understand this very well. This is important, okay? So the way this thing is done algorithmically is as follows. Okay, you're going to have in Excel, you're going to have dates. This is your dates column. And then you're going to have prices, which will turn into returns, and they will be here. And they have returns for the 3 indices, S&P 500, Hang Seng, and something else. Okay? Then, if this is 2 years, you can, these are going to be your calculation windows. So this is your data windows. Hold that here. So these are your data columns, and then this will be your calculations columns. And what you're going to do is this calculation here will be the correlation of, for example, these 2 time series. That correlation number is here. And then you can do this correlation number, which would be that, go there, and same thing here. There will be another correlation number. You have 3. Now, this will be the correlation number for the 2-year window. If this is 2 years, these will be the 2-year correlations. It's exactly what I'm asking you to do. Okay? 2 years. But I'm also asking you to do this on a rolling window. That means that you have to get this 2-year correlation here, and then there will be a number here, and then a number here, numbers here, that you obtain by moving these windows 1 day down all the time. And in Excel, it's very easy to do this. It does it automatically for you. You only have to copy this cell and then fill. And then when you do that, the correlations will automatically be done on a rolling moving window for you. So this is actually very easy. Excel allows you to do this automatically. Okay, now I don't know if this is something you already knew, or something that you didn't, but now you understand, or something which is completely new and you don't understand what I'm talking about. I wanted to make sure that you understand this because this gives you very powerful tools to analyze financial data. Okay, so maybe I can ask, can you say yes or no in the chat? Yes, you understand. No, you do not understand. It's clear. Good. All right. Very good. So it's clear. All right. So if that's clear, actually, okay, so I'm going to share again. So if that's clear, this is what you will get. It's very interesting. Okay, you're going to get a time series of this type. You're going to get 3 charts, and they will be. I'm making this up. They will be like, so this is -1 and +1. You're doing correlations, and the correlation between +1 and -1. Okay, so you're going to get 3 charts, 3, and the correlations may be like that, something like that. You're going to get 3 charts. The 3 charts will indicate the periods of dependence between the 3 variables. Okay, so for example, if this is the chart that you get, here we see something interesting. We see here we see something interesting. We see that, for example, this period here is a period of high correlation, high rho, and this period is a period of low correlation. This is important. In fact, it usually happens that the periods of high correlation correspond to periods of financial crisis. Not always, but sometimes. Okay, so you're going to be able, through the analysis of correlations over time, you're going to be able to understand some of the characteristics of the underlying markets that you're looking at. Now, you're only doing 3 correlation numbers. For what I'm saying to be true, you have to do more, many more. At some point, we will probably spend time looking into this relationship, the relationship between statistical numbers and the market microstructure. We'll probably see that. We'll see how the course continues. Okay, I have ample time, but that is something that you're going to begin to do on your own. So these are the charts that you have to get. Okay, this thing that we have here is the bonus question. That's what you have to do. It's a chart, just a chart. Okay. And you will get some interesting interpretations of that. Okay. Good. So this is what I wanted to start with. I guess it's clear. Okay, great. All right. So if that's clear, now this will start to allow us to do some good analysis of different objects. Okay, so now I'm going to I want to remind you where we stopped last week and what I'm going to be doing today. Today we're going to learn how to put portfolios together. For that, I'm going to share the screen. Today we're going to learn how to put portfolios together. And we do this in the context of how to create investment products. We already saw last week how to create investment products. We saw the indices, and then I started to talk about the fund of funds. The fund of funds were collections of were investment. There were funds themselves. It's a fund that invests in other funds. Sorry, something is not working here. I have to fix it. There we go. Okay. So there were funds. They had the same fund structure with investors, service providers, owners, but they don't trade. They just invest in other funds. And these funds will do the trading for you. That's what a fund of fund is. The thing is, when you're constructing investment vehicles, and the investment vehicles invest in other investment products. You can have investment products that invest in other investment products. They are called fund of funds. And this is one example. And now, from an investment perspective, it's clear what it is. From a legal perspective, it's clear what it is. But how do you do this? The question is now, how much money, all the money that here you have a lot of money. Here you have a lot of money. A lot of money. How do you decide how much money goes to the different funds? This is the big question. How do you take all the money in your fund and decide how much money goes to Fund 1, Fund 2, or Fund 3? This is a question that we have already seen before. In a previous assignment, I asked you to do the optimization of a hedging of a convertible arbitrage strategy. And there you had some money, maybe only $80. You had some money, and you had to decide how to allocate the money to the bond, to the short position in the stock, and to the T-bill. Okay? That's something that you already did. And you run an optimization algorithm to decide how much money goes to the bond, how much money goes to the short position on the stock. This is key. This is how you build investment portfolios. You already did it with a case of convertible arbitrage. Today, I'm going to discuss 3 methodologies that exist that allow you to decide how much money goes into each of the investment strategies that you may have. Okay, it's not just a bond and a stock like you did before. I could have maybe 100 investment opportunities, and I'm going to decide of all the money I have, how much goes to each of the 100, who gets a lot of money and who gets a little bit of money. And this has a name. This is called portfolio construction. Okay, I'm going to skip this. This is called portfolio construction. The first methodology that I want to review is very easy, but it's very important that we review it, and it's called 1 over n. 1 over n is very simple. It just says that if I have n investment opportunities, then I divide 1 over n times all the money I have is what I invest in each of them. In other words, you invest the same amount of money in each of those strategies. You don't need to know any math for this. You don't need to know any investment theory for this. You don't need to know anything. You just need to be able to divide the amount of money you have by the number of investment opportunities that you have. But let me explain. This is not something as simplistic as it looks. It is simple, but it's not simplistic. And this is what's happened. This is what's happening here. This is why this is interesting. This is interesting, and many investors do this. Many big investment houses do this. They are usually investment houses that are not very sophisticated, and they have no way of knowing which investments are better and which are worse. And they are also typically investment places, investment houses that do not rely on calculations. They do not rely on many of the methodologies we have seen here. And this was developed in an interesting context. We saw the Markovitch theory a few weeks ago. What was the Markovitch theory? The Markovitch theory is something that told us that there was, I remind you, there was an efficient frontier, and we had investments like that. Okay, so I remind you what this was so that you understand that what I'm talking about. Today, as I mentioned, we're going to make connections between this and some of the things that we have seen in the past. So it's this one here. I have to find I remind you. It was here. Remember this? We saw this a while ago. And I told you this was the methodology that was developed by Markovitch. He obtained the Nobel Prize for economics for that. Okay? And we have an efficient frontier. The efficient frontier, which is here, tells us that this investment is optimal. And this investment here is not optimal. Not optimal. So you should always invest here. And that was good. And this is a very good result that Markovitch developed in 1952. And he won the Nobel Prize. Nobel Prize in the 70s, 1977 maybe, I don't know, in the 70s. Okay, very good theory. Very good theory. But this theory has a problem. This theory, I didn't tell you that then, I'm telling you that now. So this theory has a problem, which is that it uses the expected return and it uses the standard deviation. Some people, and I'm going to show you now, some people do not believe that you can get the expected return. The expected return, I will say, is always unknown. And actually they go beyond and they say the standard deviation is also unknown. You don't know it. You may think, why? I know it. In fact, you are calculating this. We have calculated this ourselves. It was done here. It was done here. Portfolio volatility is done here. And we had the mean here, right? But this is what they say. Some professional investors, they say, yeah, this is true, but look at this number. Here's very low, here's very high. This thing is all over the place. So they say that this means this variability means that we don't know it. We don't know the mean. Okay? This is what here you need to understand the difference between the academic approach or what you may learn in school and what people actually do in practice. And they said disconnect. Okay? Academics, professors and researchers, they like this approach, it's very good. But practitioners, many of them say, I don't believe in this. I don't believe that you know the mean. And they will go beyond that and they will say, and I don't believe you know the standard deviation either. Look, the standard deviation is very low here, and then it's very high, and then very low. You say, I don't believe this. Okay? This causes skepticism. Skepticism is a word in English. Skepticism. Okay, I don't know how you say it in Chinese. It's a word in English, skepticism, that means that you don't believe in anything. Okay, you just don't believe these numbers. These numbers are not to be trusted. So this approach is interesting because it comes from people that they see this result and they see that result and say, this means that you don't know what this is. So they don't want to use it. They want to use a methodology to invest which avoids these numbers, which they don't believe in. Do you understand what I'm saying? Okay? So they would say, I am not going to believe in that, and I'm going to invest in a way that doesn't use any of that. And 1 over n is a method of investing that, they say, it's a method of investing that avoids the use of any calculated number. So this is no calculated number is used. No calculated number is used. This is it's very important for some people to not use a calculated number because they don't believe in them. They see that calculated numbers, they are changing all over the place. They change too much, so you should not believe them. Okay? I wanted you to do this assignment number 7 that I gave you, where you are going to calculate the correlation over time, so that you can also see how these numbers change. But then we're going to learn that these numbers changing does not mean that we don't know what they are. Something else is happening, and we'll learn that ourselves later. Okay? But for the people who don't believe in that, they have this methodology, 1 over n. They would say that Markowitz theory is very dependent on the estimators for expected return and standard deviation. And they say, I don't believe in that. So they don't want to use it. These are people who don't want to use Markowitz theory. Okay? There is another fact, which is Markowitz theory. I'm not going to ask you to implement Markowitz theory on your own because it's complicated. But I'm telling you that Markowitz theory leads to very concentrated portfolios. You pick a few of the good investments and you put all your money there. Some people don't like that. They like to diversify by spreading the investment over many assets. And this is very good. This is very good diversification. Very good diversification, okay? And it is something that like I say here, some authors proposed simpler allocation techniques. And some papers, I have the papers here. This is one papers. These are articles, okay? Published by a few people. I have the names of the people here. Definetti, Tobin, Samuelson, and others. Okay. The leaders of this are De Miguel, Galapi, and Upal. So these people, they wrote articles, papers, where they compare Markowitz with 1 over n, and they see that 1 over n wins. Okay? That's why they like it. So this is the context for this. It's a contest of skepticism, which in English means you don't believe. You don't believe. You don't believe in the mathematics. You don't believe in the methods that I'm telling you about. And because of that, you invest like this. I hope it's clear, okay? And some large institutional investors do this. Some of you may have a job at an investment place, and that's how they invest. And when you see that, you should now understand why they do it. It is not that they are not smart or sophisticated. It's just that they don't believe in many of the calculations that you may do. So this is the first method of investing. It's called 1 over n. And it's a method that is based out of skepticism. The second one, which is very popular, is one of the most popular methods today. It's called equal risk contribution. So this method is a little bit skeptical. It does not believe in expected return, but believes in standard deviation. It believes in standard deviation. Okay. So if I go to my previous analysis here, they would say, I don't believe in this. I don't believe in this. But I believe in this. Now, why would someone believe in this and not in the mean? The problem with the mean is becomes positive and negative and goes up and down. Okay, from negative, and this has deep consequences. Meaning the allocation depends too much on the mean. The allocation depends too much on the mean. The allocation does not depend too much on the standard deviation. And the standard deviation, as you can see, I mean, this is an exceptional, but it's much more stable. It's more stable over time. Standard deviation is more stable over time. That's why there are some people who believe in the standard deviation but do not believe in the mean. You can see that here also. I remind you, this is another graph that we saw, and they see this. Look at this. Look at the return. This is 0, so it's very high and very low. It's really all over the place. But when you look at the standard deviation, although it moves a lot, this investment stays here. This investment stays here. This investment stays here. They move a lot less. The standard deviation moves a lot less than the return. And that's why some people, they believe in the standard deviation and do not believe in the return. Another reason. And finally, something else that we saw the Sharpe ratio. The Sharpe ratio was here. We want to optimize this. We want to optimize that with the Sharpe ratio. And see, in the Sharpe ratio, you have the numerator with mu and the denominator with sigma. Sigma is always positive, but mu is positive or negative. And because it's in the numerator, it makes the Sharpe ratio very dependent on the mu. And you don't believe in the mu, therefore you don't believe in this, even if you believe in the standard deviation. Okay? So this is why there are some people who prefer to have a method that does not use the mean. So this has no use of the mean, no mean, but it does use the standard deviation. And this is such method. Okay? This is why people develop this. Now, to explain this method, there's a piece of mathematics which I need you to understand. And I don't know how much of this you know, but I'm going to tell you. If you want to ask me a question, you go ahead and ask me questions. But I have to explain something to you before I explain to you what is the nature of this allocation strategy. So as usual, we start with a portfolio which allocates, this is the amount of money that goes to each investment. We call it W for wealth. Okay? Wealth or weight. It says how much money I put into each investment or what percentage of my wealth goes into each investment. And now we saw this formula. We saw that the portfolio volatility was the square root of the product of the weights times the variance covariance matrix times the weight vector transposed. We saw this earlier. I remind you where we saw that. So today I have to go back between these two between these two? It was right here. Remember? We saw that here. The portfolio volatility, okay, is this expression here, is the sum of all the possible products between the different weights or wealth allocated to each investment times the covariance between those investments, which we can express in matrix form like that. So from that perspective, now I go back to today's notes. See, we're going back between two lecture notes today, okay? And that's the portfolio volatility. Okay, this is the portfolio volatility, and now there is a calculation that I'm going to do, a calculation that requires the use of a partial derivative. I assume you know what a partial derivative is. If this is my portfolio volatility is a function of the weights. Remember, the weights are my unknowns. I don't know how much money I'm going to put to each of my investments. That's what I'm trying to solve. So I look at the portfolio volatility as a function of my weights. And because of this formula, there's a very beautiful expression that says that this volatility, look at this, it's the sum of the partial derivatives of the volatility with respect to the weights. It's right here, okay? I'm gonna highlight that in yellow. The partial derivative of the volatility with respect to the weights multiplied by the weights is equal to the volatility. This is a formula you can check by partial differentiation. You can do this on your own if you want to. It's a long calculation. I'm not going to do it here, but it's something that you will have. I mean, you know how to do this. You know how to take partial derivatives, and if you take the partial derivative of this expression, multiply by the weight and add, you get the volatility again. It's a formula. Okay, so this is a formula. It's a good formula. So this is it's just a formula. But it's a formula has a very interesting interpretation. It's this one. This is the risk of my portfolio. So the risk of my portfolio is the weighted average of these numbers. Is the weighted average of these numbers. So this formula gives a name to these numbers. These numbers are called the marginal risk contribution. In other words, these numbers, whatever they are, is considered to be the contribution of investment label I to my whole investment portfolio. In other words, my investment portfolio has a certain amount of risk. And this risk comes from each of the investments that I make. And this formula expresses the relationship, linear relationship, between the risk of my portfolio and the risk contribution of each of the assets, each of the investments that I'm going to make. Okay? This formula is very important. It's the basis for what we're developing here. So from here, from this expression that breaks down the risk into different units, each unit associated to each of my investments, then the investors come and they say, what I want is I want the risk contribution to be the same for each of my investments. I want the risk contribution to be the same. See, note one thing, the average return is not used because they don't believe in it. But sigma is used. They believe in sigma. So this is an allocation which is based on the concept of risk. Only risk, no return. Only risk, no return. So we want to allocate in such a way that the risk numbers are the same by assets. Which is the same as to say that this should be true for all I and all j. And this is a system of equations, which is the system of equations you use to find out what the weights are. This requires a difficult calculation, but I'm not talking about the calculation today. I'm only talking about the allocation methodology, the allocation formula. Okay? It makes the allocation to the assets to be the same from a risk perspective. And this is interesting now, because watch one thing. The previous allocation methodology was same money to each investment. This is what this allocation was. Same money to each investment. This one is same risk to each investment. This is the philosophy for this. In the 1 over n is the same amount of money. Here's the same amount of risk. Okay? And some people like this. I have to say that this is very popular. Very popular. Very popular. It works well, and it's done by people who believe in the standard deviation and do not believe in the expected return. Okay? Okay, I hope this is understood. We're going to do some calculations with this in the assignments. You will get to understand this better. But today I want you to understand the philosophy of why these things are done like this. Let me continue. There's a third one. There are three. The third one is also based on the concept of risk, but the approach is different. It's called a minimum variance portfolio. Minimum variance. You just want to minimize risk altogether. So you just want the portfolio with the lowest risk. Not that the risk is the same for all of my components. No. The risk is the lowest. So this is interesting because this has a connection with the Markovitch theory. In the Markovitch theory, I remind you, this was the Markovitch theory. I'm going to go, say here. Okay, in the Markovitch theory, I told you there was the expected return and the risk. And now these people, they do not believe in the return. So what they do is they look at this from the risk perspective and they just go here. Minimum risk. Minimum risk. Minimum variance portfolio. Okay? This is one allocation methodology that I can explain from the Markovitch efficient frontier. They want to invest in the part of the efficient frontier with the lowest risk. Okay? So this is a very conservative approach. Now, if you're, I hope, I don't know if you understand what I'm going to tell you now. It is not very important, but this is how I go from this concept of minimum risk to an actual formula. And for that, I have to use something which is called the Lagrange multipliers. It's something advanced in multivariable calculus, and I don't know if you know it, okay? But if I want to calculate the portfolio with a minimum variance, the way I do that is I set up an optimization algorithm and an optimization problem. So minimizing the variance is this. I minimize the variance. This is you know that when you're minimizing something, the gradient is 0. But if you are minimizing something with constraints, then the gradient is not 0. The gradient will be perpendicular to your set of constraints. So in this context, this is called Lagrange multipliers. So in this case, my gradient, not zero, will have to be orthogonal, will have to be perpendicular to my restrictions. What are my restrictions? My restrictions is that I have to invest all my money. So the sum of all the weights has to be 100% of my money. That's the restriction I have. Okay? So this objective function should have a gradient which is perpendicular, orthogonal to the plane that gives me those restrictions. Okay, I don't know if this is something you have seen. I am sure you have seen this. I am sure you have seen this. Okay, it comes from multivariate mathematics. But I'm not interested in the mathematics. I'm interested in the conclusions of that. Because once you set up this Lagrange multiplier equation, the result is that you have to have these things to hold. Okay? The sigma squared, what was sigma squared? Sigma squared, remind you, was the sum of all the possible products of the weights and the covariances between the assets. What's the gradient of that? The gradient of that is a vector. You can do this, right? It is it's a vector which is the partial derivative of my expression here is the sum of my Wj is sigma ij. That's what that vector is. The diagonal is a little bit different. Okay, the diagonal is going to be 2 Wi sigma I, and this is the sum in j. So this is the vector, which is the gradient of that. And if this has to be orthogonal to that plane, then the orthogonality of this vector with the plane implies that equation. Okay, because these are each of these components is the partial derivative of sigma with respect to tau. Okay, that's how you get this expression here. So we are done. We just finished deriving the 3 allocation methodologies which are common today in the 21st century. 3. Okay, so I'm going to summarize them as follows. Just went through that. The first was equal weights, 1 over n. Okay, all the weights are the same. The amount of money to each of my investments is the same across the board. Next is equal risk contributions. Equal risk contributions. And the expressions that they give rise to is this one. The partial derivative of the variance or the standard deviation volatility, portfolio volatility sigma with respect to each of the assets is the same for every pair, for all is all. For all I and j, they're all the same. Okay, and then finally minimum variance, which means that the partial derivative of my volatility to each of the weights is the same for all possible pairs also. Okay? So 3 allocation methodologies, 3 ways to build investment portfolios, and the resulting expressions are very similar. Look at that. They're very similar. The results are very different, but the expressions are very similar. And they all have something in common. They're all expressed as systems of equations. Systems of, in this case, they are linear. In this case, they are non-linear systems of equations. they have solutions which are a little bit complicated, but what I want to do is I want to spend the rest of the class going through a particular case where we can get some intuition as to what these allocation methodologies mean. Okay? Is this clear? By the way, the assignment I will give you this week is with the 3 indices that you downloaded, that you worked with in previous assignments. In the previous assignment, I want you to calculate the portfolio that uses each of these methodologies. That's what the next assignment is going to be. I'm going to give each of you $1 million, and I want you to tell me of the $1 million, how much money goes into each of the investments, how much you put into the S&P 500, how much into the Hang Seng, and how much into the HFR. That's what your assignment is going to be. Okay? So you are going to make your first investment in this course with $1 million. And you have to use these methodologies. For that to happen, I need you to understand what these methodologies are and how we actually calculate them. I'm going to talk about the applications of these methodologies. Okay? So are you with me? Is this all clear? I am very aware that the class today is very technical. It's very mathematical, although we started with something very simple, 1 over n. Right? Although we say with something very simple, I am aware that this is very complex to understand, and so is this. Okay? But, so let me ask you a question before we go on to make sure that we all understand what we're doing. Let's say that I give each of you $1 million, and I need you to tell me or to construct for me 3 investment portfolios for each of the 3 methodologies we have here. How much goes into the Hang Seng Index, how much into the S&P, how much into the HFR. So I have a question for you. In this methodology, how much money goes into the Hang Seng Index? You can answer this. You don't need a calculator for this, but I want to make sure that you understand what we're talking about. So here's a question. My question to you is, in this methodology, how much money goes into the Hang Seng Index? Oh, sorry, there's a question by B. Minghao. The data where we can download. Oh, you don't know where to download the data. You go to Yahoo Finance. I'll show you. I thought I showed you last week. I'll show you again. Okay. But so we don't need data for this. So in this methodology, how much money goes into the Hang Seng Index? You have $1 million. How much money of the $1 million goes into the Hang Seng Index? So there are 3 investments that we have here: S&P 500, Hang Seng Index, and the Global HFR Index. And you have $1 million. And I'm asking you how much money goes there. Of the 1 million, how much goes into the Hang Seng Index? No? Not clear? 1/3, exactly right. This is easy. It's not hard. Okay. We go here. So someone asked Song Yixin. You answer gave the right answer, which is in this methodology, $333,333 with 33 cents goes into the Hang Seng Index. How much money goes into the S&P 500 index? How much money goes into the S&P 500? I'm sure Song Yi-Sing, you know the answer to this also. The same, exactly the same. And how much money goes into the HFR? How much money goes into the HFR? The same too. So in this methodology, equal weights, everybody gets the same amount of money. If you have $1 million, then you put $1 million into the Hang Seng, $1 million into the S&P 500, and $1 million in the HFR. That's easy, okay? All right, so the first one is always very easy. It's always very easy, but still many investors use it. How about the second one? You cannot answer that question, not in this class, okay? This is the assignment that you will do, and this assignment it's a little bit complicated, okay? So maybe I will have to break it down into parts. That's why I want to understand how much of all of this you understand today, okay? By the way, I'll say something. What we're seeing today is very advanced. It's very advanced, okay? And very few people know it. So today, as I like to say, you are climbing a very high mountain. You are climbing a very high mountain today. Okay, so how do we do this? So let me explain this, because I want you to be able to do these calculations on your own. And I will, again, I assume that you know how to make these calculations. So let's assume that our assets have a zero correlation. I know they don't. In fact, in your assignment number 7, you are calculating the correlations, and you will know that the correlation is not zero, okay? It's not zero, but when the correlation is zero, we can make these calculations easily. Again, this is just for intuition. I'm doing this calculation just so you get some intuition. The 1/n has some very good intuition, but if the other ones don't, okay? And by the way, if you find this assignment difficult and you want to assume that the correlation is zero, with the zero correlation, the formula is very simple. And if that's the best you can do, then that's okay. Okay, I prefer that you do, I'll take some marks off, but that's okay if you want to assume the correlation is zero. Because when the correlation is zero, look what happens. When the correlation is zero, the portfolio volatility is just this. It's the sum of the individual volatilities squared, multiplied by the weight squared, you sum, and then you take the square root of that. No correlations, so no cross terms. And therefore, in this, the partial derivative of my volatility, portfolio volatility, is the expression that we have here. Okay? This is calculus. You know how to do this. So if that's the case, and again, we can only do this, when we have no correlation. If that's the case, this is the numbers that come up. Equal weights, we already know. It was, with $1 million, it was $333,333. But how about the equal risk contributions? Again, this is with uncorrelated, this is assuming the correlation is zero. So if the correlation is zero, look at the expression here. Remember this? Well, if I take that with that, see, look at this, right? If I plug in this value for what I have here for this, then the term simplify, and this is exactly what I have. The weight is 1 divided by the standard deviation of that particular investment. That's it. That's it. And when you go here, you have the weight is 1 over the square root, so 1 over the square of that particular investment. Okay? Also, the square. So when correlation is 0, you can answer my question by simply calculating the standard deviation of each of those indices. But what was my assignment number 7? What was my assignment number 7? I asked you to get all of these and calculate the correlation matrix of the daily returns. So to do this assignment, the only thing you have to do is calculate something even easier than the correlation. You just have to calculate the standard deviation for the whole period. Okay? Because once you have the standard deviation for the whole period, then you know how much money goes into each of those investments. Is this understood? I think it's, yeah, some people are saying yes, I think it's understood. In the case of 0 correlation, this is very, very easy. Very, very easy. I have an example here for you, okay? So something that I have done for you. Okay, so if this was your case, I didn't use the Hang Seng, I used a bond index, but it's exactly the same calculation. Okay, so here in your assignment, the bond will be replaced by the Hang Seng. The bond will be replaced by the Hang Seng. That will be the Hang Seng index in your assignment. Okay, here I've done it for the bond index. In your case, you will do it for the Hang Seng. The stock will be the S&P 500, and the hedge fund is the global hedge fund index, the same that I asked you to download. And I'm going to go and answer the question that I was asked, which is where we can download the data. So in this case, what I have is that when I do the calculation, I see that the standard deviation of this investment is 15%. The standard deviation of this investment is 30%, and the standard deviation of this investment is 10%. So the equal weights, well, it's very clear. It's a third, a third, a third. Just like Song Yixin said, a third, a third, a third. That's always easy. You just divide by the number of assets. You have 3, so it's 1/3, always. That's easy. But then when you go to the next one, you have to divide not by 3, but you have to give each of them an allocation which is proportional to that. Okay? So you have to here solve the equation that we mentioned earlier, which is that in this one, the weight is 1 over the volatility. So this would be, this would be 1 over 15%, that's 1 over 30%, and that's 1 over 50%. Multiplied by the $1 million that you have, and divided by the sum of all of this. So this has to be normalized so that you end up with something which adds to 100%. So these are the allocations normalized so that they add to 100%. So this is something that you can do. Okay? this is something that you can do. In the case of zero correlation, again, if this assignment is too difficult for you, then assign zero correlation and then you can get it easy, like I did here. Okay, but I prefer that you do it with the actual correlation. It's a bit more challenging, but I will explain how you do that. Okay, this is what I want to do today. I want to make sure that you all know how to do this. These are the three most important investment methodologies that exist today. 20 years ago was Markovitch, but today these are the ones, and I want you to be able to do them. And then finally, for the last one, how do we do this? Well, for the last one, we have the formula is 1 over sigma squared. Because we have the sigmas here, this number is 1 over 15% squared. This number is 1 over 30% squared. And this number is 1 over 10% squared. I made a mistake, this is 10, okay? That's not 10% squared. Normalized so that they add up to $1 million. Okay? Before I continue and I answer the question where you get the data, can you write on the chat yes or no? Yes, you understand. No, you do not understand. Okay, good. It is understood. That's good. That's good. Okay. All right. So I think I'm done. This is what I wanted you to understand, and then the next assignment will follow. Okay. I'll try to write it right after class. I hope it's clear. If it's not clear, you tell me, and then I'll include more details in the assignment. Okay. That I will circulate to you. So let me address the other question that was given, which is where you download the data. By the way, let me ask, who has already downloaded the data? Can you say, please, someone? Have you already downloaded the data for assignment number 7? Someone? No one has downloaded the data? Okay. So I'm going to show you, okay? So, I mean, the HFR, I already show you. Okay, so I'll show you where to download the data. I'm looking for that. I mean, there's many places. I'll just show you the places that I have used. Okay, so here we go. We're going to now share the screen, see what there's to do. There we go. All right, there we go. So this is the Yahoo Finance webpage. This is the Hang Seng Index. And then you have historical data there. You can take a time period and then you hit download. That's it. You have to specify the time period. That's for the Hang Seng Index. The S&P 500 would be the same. You can also get it from here. Okay, S&P 500. Here we go. Oh, sorry, this is not where I wanted. I want the prices, not the. As you know, today is a holiday in New York, here in Toronto also, so the markets are closed. Okay, so I just do this and if I run it. Historical data. That's how you do it. I'm surprised that you're asking. There we go, and it's the same thing. Historical data, historical prices, and then you download. Where's the download? Summary conversations. For some reason, I don't get the download button here now. Should be right there. It will download as a CSV file, typically a comma separated values file, CSV, that you can open in Excel. I don't know why it's not giving me the download button. Let me try again, okay? Something may be happening. Okay, let me leave it as SPY. Okay, so if that doesn't work, I don't know why. You can download the SPY, which is the same. It's the ETF for the S&P 500. It's right here, and then you download right there. I don't know why the S&P 500 didn't give me the download data. I don't know. Okay, it's supposed to, but this is the same. It's the S&P 500 ETF. The ticker symbol is SPY. Okay. That's where you download the data. And then finally, the other one is you have to go to HFR. I already showed you it was right here, I believe. HFR. And this is where you download the data for the third index. The third index is the hedge fund index. It's the one that has, there we go, download HFRX. So you have to log in. That's my login. You have yours. For internal purposes, there we go, submit. Why? I don't know why I'm being asked this now, so I have no idea. This one here. Okay, and then you just download the HFRX in this daily. You want the daily performance, not the monthly, daily performance, and then you get a CSV file. And this is the interesting part, because when you download this data, you're going to get data from approximately 2003. So for the S&P 500, when you have to select the data, the S&P 500 and the Hang Seng go back a lot more than 2003. So you have to take the common history. Okay, so before you start downloading, you have to get the history of each of them and take the period of history which is common. And then you download the data for those days, and now you have a 3-time series for the 3 indices, which is the same. You don't need anything which is before 2003 because since you don't have the HFRX index, you cannot implement this investment methodology going back to 2003. So you do not need data before 2003. Okay, you have to check for the common history for all of these investments and take the one which is common. And then with that, you get 3-time series. And with those 3-time series, you can analyze, this is what you have to do for that. Then in assignment 7, you will do the correlation matrix. But then I should also ask, you have to do the sigmas, the portfolio volatilities for each of them, because you need them for the allocation methodologies for each of those. Okay. And it won't be very difficult. Once you get all your data, you have to organize the data. You have dates. And don't forget, returns. From the prices that you download, you have to go to returns. Don't do the calculation on prices. You get the wrong number. So with these, it looks like I'm losing my voice now. I'm sorry. Allow me to. Sorry, I'm losing my voice. I hope I can wait at least 5 more minutes and we can finish the class, okay? So you download the data, you have to turn the data into the daily return numbers. So these are daily return numbers, returns, don't forget. And then from the daily returns, you can get the sigmas and the rows and the mu's and everything. And that's how you get it. You get it from all of this. Okay. This is a very advanced project that you're doing today. It's very advanced. With 0 correlations, this is easy. But now, what if you don't have 0 correlations? What do? What if the correlations are, and they are not 0? You have calculated the correlations in assignment 7. The correlations here will not be 0, then what do? So this is what you do. And this is the part which is, again, I consider this to be a bonus question. Okay, these are the equations that you have to solve. These are the equations that you have to solve. This is a system of equations. In your case, that's a system of 3 by 3 equations. In this assumption, when I said that the correlations are 0, I could calculate these partial derivatives explicitly, but when they are not 0, this calculation is more complex. It's more complex if correlations are not 0. So what you need to do is you need to go to this expression and, without assuming correlations are 0, get what that expression would be. And then you need to solve the system of equations with your computer. You only need, with the time series, you only need to calculate the various covariance matrix that you already have with numbers here. You just need 3 numbers, and you need, and the, well, this is the correlation. Sorry, this is the correlation. I'm not it's better for this that you use the covariance. Sorry, I'm going to write the covariance. So you need a covariance matrix. The covariance matrix will have these ones in the diagonal, and then it's going to have the correlations here. The covariances 1, 2, 1, 3, 2, 3, and the same here 1, 2, 1, 3, 2, 3. This is your covariance matrix. You're going to get the covariance matrix, and that's all you need. Now, with the covariance matrix, you're now going to go and calculate this sigma by the W, and you're going to be solving the system of equations, which is either these ones for the minimum risk or these ones for the equal risk contributions, where this is V and sigma is the sum of all of these numbers so you have to go from here to here and from here to here, and then solve these systems of equations. Okay. I'm thinking that maybe this is advanced. Maybe I give you, maybe I break this assignment into two parts. One for zero covariance and another one for non-zero covariance. And then I give you an extra week to do that. Okay, because this is a substantial assignment. But the result would be the amount of money, and I remind you, you have $1 million to invest. You have $1 million to invest, and you have to invest $1 million in each of these three indices. Okay? Let me just make sure that I've covered everything I wanted to cover today. Yeah, this is something which is, yeah, this will happen tomorrow, next week, sorry. Okay? All right. So, uncorrelated assets, you have to do the same for the correlated assets, for the Hang Seng Index, S&P, and HFR. Okay, so I hope today's class was clear. Okay, it's very advanced, and I don't know how many of you are lost. I hope I didn't lose anybody. I will know when you send me the assignment. Then I will know if all of this has been understood. Any questions? I have 5 minutes left. So we can end class early, or I can answer questions for 5 minutes. All clear? Then I can ask you a favor. If it's all clear, please write yes on the chat. If the assignment is clear. If it's not clear, write no. Okay, it's clear. Very good. Okay, so my voice managed to wait until the end, and I will finish 5 minutes early today. Okay. Very good. So have a good weekend. You will get the assignment from me. I'll decide if I do this into 2 assignments or just 1. I will see. It looks like you understood. Maybe I do it all in 1. And then if you have difficulties, I give you an extension. Maybe that's what I do. But I really want you to do this calculation. This is very important. Okay? Very good. Okay, so have a good weekend, and I'll see you next week. Goodbye.